If you trade smart money concepts, you have been told the inverse fair value gap is the upgrade, the smarter trade, the higher probability signal. So we tested it. 146,000 gaps, 5 years of the Nasdaq and the S&P. Here's the answer up front. At 1-to-1, the plain gap wins 57.5%. The inverse gap wins 58%. That is a tie. And here's the part nobody puts in the thumbnail. At 1-to-1, both of them lose money. The inverse gap is not stronger. It just fires about a quarter less often, so you wait a lot longer to lose the same way. So why does the smart money crowd swear by it? And what actually decides whether either gap makes a dollar? Because it has nothing to do with which gap you picked. Stay, and I will show you the two levers that flip both of them green. Quick definition so this is fair. A fair value gap is a three-candle gap, a hole in price where one side never traded. The plain play is continuation. Price comes back, taps the gap, and you trade it in the same direction the gap pointed. Now, sometimes price does not respect it. A candle closes clean through the gap. ICT teaches that the gap does not just die there, it inverts. Support becomes resistance, resistance becomes support. That flipped zone is the inverse fair value gap, the iFVG, and you trade the reversal off it. The whole pitch is that the inverse is the stronger signal, because a gap that failed and flipped proves the order flow changed. It sounds right, so we tested whether it actually is. Here is how we made it a fair fight. 5 years, the Nasdaq and the S&P, 1 minute and 5 minute, every regular session. We found every real fair value gap, the kind with a true displacement candle, not a 2-point nick, 35,000 of them. Then we traded both signals the exact same disciplined way. Enter only on a rejection close, never a bear tap. Stop at the far edge of the gap. Same targets, 1, 2, and 3-to-1. For the plain gap, we took the continuation. For the inverse, we waited for the gap to actually fail and flip, then took the reversal. Same gaps, same rules, same 5 years. And the gaps did fail a lot. 3 out of 4 of these real gaps eventually got closed through, which is exactly when an inverse gap is born. So there was no shortage of inverse setups to test. Now, the scoreboard. So which gap is stronger? Here are the win rates side by side on the real gaps at 1-to-1. The plain fair value gap, 57.5%. The inverse fair value gap, 58.0%. Half of 1% apart on almost 40,000 trades. Statistically, that is the same number. The thing the entire smart money crowd treats as an upgrade is, on the actual data, a coin flip against the original. But here's the part nobody puts in the thumbnail. Look at the money, not just the win rate. At 1-to-1, both of them lose. The plain gap is down almost $300,000. The inverse gap is down $114,000. 2 high win rates, both bleeding cash. Because a 58% win rate at 1-to-1 cannot survive a stop that bails late. We have seen this trap before on this channel. The win rate is a costume. Now let me be fair to the inverse gap, because there is one place it does win, and we are not going to hide it. Move the target out. At 2-to-1, the inverse gap flips green, up almost $35,000, while the plain gap is still red. At 3-to-1, the inverse gap makes $169,000 versus the plain gap's $125,000, and it does it on fewer trades. So if you put a gun to my head, at the bigger targets, the inverse gap is a hair better. But a hair is the word. The lead is tiny. It is inconsistent. On the medium-sized gaps, the plain gap actually takes the lead back. And here's the cost nobody mentions. The inverse gap fires about a quarter less often, 17,000 setups versus 23,000. You wait for the gap to fail, then wait again for it to flip, then wait again for the rejection. 3 waits for a coin flip's worth of edge. That is the honest verdict on the inverse gap. Not stronger, barely different, and slower. So if the gap type barely matters, what does? The first thing the data screamed at us was the target. Watch this. At 1-to-1, both gaps lose money. Same gaps, same entries, but now let the winners run to 3-to-1. The plain gap goes from down 300,000 to up 125,000. The inverse goes from down 114,000 to up 169,000. The win rate dropped from 58% to 30%. You win way less often and you make way more money. That is the whole win rate trap in one chart. The lazy trader caps the winner at 1-to-1 to protect a pretty win rate and quietly bleeds. The edge was never in choosing the right gap, it was in how far you were willing to let the right gap run. The second lever is size, and this one rescues even the 1-to-1 trade. Most fair value gaps are small, and small gaps are noise. Filter out the junk and only trade gaps that are at least average sized, as big as the market's normal move. Watch the 1-to-1 result, the one that was bleeding. The plain gap goes from down 300,000 to up 70,000. The inverse goes from down 114,000 to up 124,000. Same 1-to-1 target. The only change is we threw out the tiny gaps. Push the size filter higher and both stay green. So there is your real playbook. And notice the inverse gap is nowhere in it. Trade a real displacement-sized gap. Let it run past 1-to-1. Do that, and whether you call it a fair value gap or an inverse fair value gap is almost a rounding error. We checked this every way we could because a tie is easy to fake. Split it by market. Nasdaq 1 minute, Nasdaq 5 minute, S&P 1 minute, S&P 5 minute. In only one of those four did the inverse gap even edge ahead, and by a single point. In the other three, it tied or came out behind. Swap to the strictest possible stop, the pessimistic hard stop that gets wicked out more, and the answer does not change. Still a tie. There is no market, no time frame, no stop model where the inverse gap is the upgrade it is sold as. So here are two real trades from the test, side by side. A plain fair value gap holding and running to target, and an inverse gap where the first gap failed, flipped, and the reversal paid. Both win. Both are fine. Neither is magic. That is the point. The honesty the hype reels skip. This does not prove the inverse gap is bad. It is a perfectly good tool. It proves it is not a stronger tool, not the cheat code people sell it as. This is the Nasdaq and the S&P 1 and 5 minute, the regular session 2021 to 2026. Maybe the inverse gap shines on a higher time frame, or paired with a specific session, or as one confluence among several. We did not test every world. What we tested, head-to-head, mechanically, says they are twins. And the part the data cannot measure is the same part it never can. Which gaps to skip, when the day is wrong, the read you build from screen time. We measured that human edge in another video, and it was worth more than the setup itself. The gap is the floor. You are the rest. So here is the whole thing in 4 lines. 1. Stop arguing fair value gap versus inverse fair value gap. On the data, they are the same coin, 57.5% to 58%, a tie. 2. The inverse gap is a fine plan B when a gap fails and flips, just not a holy grail, and it makes you wait. 3. The lever that actually pays is your target. Let the gap run past 1-to-1. 4. Only trade real, displacement-sized gaps and skip the junk. We built the tool that marks both the fair value gaps and the inverse fair value gaps on your chart, flags which ones are big enough to trade, and keeps the score live, free in the Discord, with the full dataset and the script so you can rerun it and disagree. We test, you decide. And the next time someone tells you the inverse gap is the higher probability play, you can show them the tie.